Welcome to the Steam River podcast. Today we've got Noel Martin, partner in our conveyancing department, and Adam Robson from Coastal Financial. So, Noel, good place to start with you would be, what is a mortgage?
So a mortgage is a loan that's secured against the property, typically used to purchase a home, borrow a lump sum from the lender. The lender has a huge interest in the property as a result, and they secure their mortgage against the property by way of a legal charge. And that's part of our job, I guess, is to make sure that, we're not only acting for the client, but also acting for the mortgage lender and making sure their interest is protected as well.
Okay. And there are various different types of mortgages?
Yeah. So it's a mortgage product. So obviously everyone will know the fixed rates. So fixed rates are generally from, 1-year fixes used to exist, so don't really these days, but 2-year fix and a 5-year fix are the most common. There is a 3-year fix, but they're very limited by lenders. So 2 and a 5 are if you like, more.
And that's where the rate doesn't change for that period?
Yeah, precisely that. Yeah, so the rate won't change. You'll pay a fixed payment for that 2-year period, 5-year period, whatever it may be. There is 10 years, but I'd never recommend it on just 10 years. I think the market can move too much in 10 years, as we all know and have seen. Your payment will remain the same. And after that, if you did nothing, you go to what's called standard variable rate, which can be double the rate, if not triple the rate.
Right. So it doesn't just track the Bank of England rate, then it could be, they actually layer some extra on there, do they?
On the variable, but you can pick a tracker, which is another product. So the fixed is obviously one. Number 2, you could have a tracker product which follows the Bank of England base rate, plus then a margin that the lender will pick. So let's say 0.20%, and that's their margin between what they're obviously borrowing at the Bank of England rate versus the rate that you'll pay. So, or there is a variable rate, which is the standard rate, which you could leave. No one does.
Right.
Nobody wants to sit on the standard variable rate. And if there's any clients that are on standard variable rates, you need to speak to an advisor. So, because you're massively overpaying.
Right.
So double what you can pay, to be fair.
And then how do you work out how much someone could borrow?
So it's based on income expenditure, age. Age is quite a big factor, actually. I think people forget. You could have a 40, 50-year-old client and they think they can borrow the same, and they simply can't because of that term.
Right.
You'll get terms of 35, 40 years.
But if you're already...
I see this with clients as well. But I earn X. Why can't I borrow X? Because you've got such a short term.
Right.
So it all needs to fit. You need a long term. You need the income versus expenditure.
So you go through a fact find with your clients, do you?
Precisely that. Yeah. So we'll get our fact finds. We'll check the affordability with the lenders. We do it individually, so we'll check each lender individually to make sure it's 100% correct. Some people will use a 4.5 times income calculator, but I just don't find that accurate.
Right.
You need a true calculator with the individual lender to see. It's what goes in versus what comes out. So if you earn 50,000, it's not automatically 4 times or 4.5 times. There's your commitments to come off of that. There's dependents, children. That's a big factor as well. How many of you are on the application? Term. There's so many bits.
Value of the property.
Value of the property.
Yeah. Okay.
Yeah. Loan to value has an impact as well. Not people know this. Is the higher the loan to value. So let assume people know loan to value. Assume they don't for now.
Yeah.
£100,000 property, £90,000 borrowing, 90% loan to value. Simple as that. The higher the loan to value, the more risk it is to the bank. So they actually lower the borrowings. Something like NatWest do that in particular.
Yeah.
So the lower the loan to value, the more borrowing you get sometimes as well. So you'll often get clients who'll go, my friends borrowed this and they've got their income, but there's so many variables you just can't do that.
And the loan to value generally affects the interest rates as well.
Affects interest rates.
The interest rate goes up. So the loan to value goes up.
Yeah. The high loan to value, high interest rates.
Yeah.
Because of the risk to the bank.
Yeah.
Which seems almost counterproductive. You think, I'm paying high interest rate because I'm more risk, but I'm paying more, so I can't afford as much. So it's a funny old thing, but you've got to look at the bank as like a business. They're taking more of a risk.
Yeah.
So they need more of a reward, effectively.
Are there any other costs people should think about, like stamp duty and...
the costs involved in terms of buying, would include stamp duty. It would include...
Is that often
fees.
not included when you're talking about mortgages?
Yeah.
So you have to have that sort of separate plus your deposit as well?
Yeah, exactly. So, there's always the stamp duty aspect. I mean, unless obviously you're a first-time buyer. Things that often get forgotten about are your disbursements, such as stamp duty, land registry fees to actually register you as the owner and the mortgage. They can also escalate, and we send out quotes sometimes, and people think, blimey, look at the final figure, but actually, probably half, if not more than half, tends to be the disbursements that they have to pay as part of the buying process. So yeah, it's always good to get an idea of the total costs. And then obviously on top of that, you've got any mortgage product fees, mortgage arrangement fees, and any other costs that could come up. So yeah, it's always good to go in, wide-eyed and get an idea as to all of the costs before you start looking at your affordability.
Yeah. So I find that clients actually, they'll say, "Oh, for this quote, when it seems high," yeah, but only a small percentage of that is actually the
legal fees.
The legal fees, yeah, because I don't realise that.
So do you see people that might borrow a bit more to pay for stamp duty? But it's a big tax, effectively, isn't it?
Yeah, especially on home movers when they're moving home, needing a mortgage, they want to borrow the extra to cover the costs, including fees sometimes. Because you mentioned about lender fees.
Yeah,
most people add them to the loan. You obviously pay interest on that, and you have to tell them that. But somebody, lender having a 999 product fee, most people aren't going to go, there you go, there's £1,000 out of my own pocket to run around to low. It gets so much lost in the loan.
Yes.
But you are obviously paying interest on it. But
for the term of the mortgage.
For the term of the mortgage,
right,
or until you pay it off. Yeah.
So when should someone consider remortgaging?
So we say 3 to 6 months before. Just so it's nice and relaxed, because then if it could come up, can it? It's minimum 3 months. 6 months can be early, but most lenders will let you do it between your deal ending 6 months before. One good thing about doing it that time, let's say we got a deal for a client, this has happened a lot recently. Let's say you did it 5 months before the current deal's ending, and then a newer rate comes out, a cheaper rate, we can then get a new cheaper rate. As simple as that. We can just go back to them and say, actually, we want this rate because it's cheaper, and they'll change it. So it's quite handy, and I've done that.
And what's the remortgage process look like from the legal side? Is it quicker than purchasing?
Yeah, definitely quicker than purchasing. I think for freehold properties, it can be turned around very quickly once the offer is in hand. But with leasehold properties, flats and whatnot, maisonettes, more recently, it's become bit more of an issue because lenders have changed their requirements quite a lot. So it's still going to be quicker than buying a leasehold flat, but yeah, there are aspects of leasehold transactions which tend to slow it down. So yeah, it's always best to instruct on a remortgage sooner rather than later, because you don't want to be in a position where your fixed rates come to an end and there are delays as a result of the management company or any other.
And the remortgaging, is that often to try and bring down your monthly payments, or is that to maybe go on holiday, buy a car or something? Different reasons.
Most of the times, because that they say fixed rate or tracker rate's ended, or a certain product they're on is ended. That's the main reason. Because obviously remortgage on the existing property they're in. So yeah, generally people want to remortgage and save, and that has been the case for most of my career. But in the last few years, remortgaging and unfortunately it's doubled,
right?
Which has been a shame. Yeah, it has. It's because interest rates.
The rates.
Yeah, because people are on let's say 2% to round it, and then now they're on 5% when that first happened.
Yeah.
So it's quite a shock for some.
Yeah, I bet.
Which is why I think they have to be careful when they're trying to balance these rates.
Yes.
Yeah. So I stat the other week that only around half of people have actually noticed the effect of the interest rates. People still on fixed deal.
Right. Yeah.
If you're lucky enough.
There's a sort of tidal wave of people that are suddenly going to get the pinch.
Yeah. Every single day it goes on. Everyone is remortgaging from these lower rates, these higher rates. I mean, they have come down, but they're still high compared to what they used to.
Yeah.
But yeah, every single day it's really shocked some people. And we live in a finance world now, don't we? So everyone is very much on the edge.
Yeah. So how does credit scores and things like that affect?
Massively. And that will be interesting, a knock-on effect from the interest rates.
Right.
I think in years to come. But yeah, huge. People don't realise, and we're saying it's a credit world, people don't realise the effect on the credit score. I mean, lenders, when they do an agreeing principle, they'll check your credit score.
Yeah.
So it's literally a yes or a no by the lender.
And is that part of the service that you offer, sort of helping people?
Yeah.
Increase the credit score?
Yeah. Looking at advice and things like that. I mean, it's simple everyday stuff, making payments on time. Credit utilisation is a big one as well. So I've seen people might not be in any arrears, but they might have a lot of credit compared to their income. A lot of lenders don't like that either. Like an application to climb because they've said your debt to income ratio, as they thought, was too high. And that could be people that are wealthy as well. You think,
Yeah.
It's but yeah, credit score's huge. It's always worth checking your credit score before applying.
Yeah.
Definitely.
And what have you seen in the market recently? Well,
So I mean, yeah, we've seen a surge, especially over summer months, of home movers. I think a lot of people downsizing, I'm finding as well. Obviously, the cost of living has had a bit of an impact because we're seeing a lot more downsizing than upsizing. But yeah, no, I mean, it's there's still plenty of people moving.
Yeah.
Still, loads of work coming in, and it's a busy market.
do you think
so.
some of that downsizing is to release capital to then maybe help their children?
I think so. I think it's hard to say really. I mean, I have had a few where they're literally, selling a buy-to-let and giving the money straight to their child to then buy it, onwards. Because it is becoming harder and harder for first-time buyers to get their foot in the door.
How would a parent protect the interest, or is it just a gift?
Yeah, I think most lenders would probably take issue if they wanted to protect it. So if they were giving a loan, for example, then it would be a second loan. I think most lenders would probably take issue with a second loan. So generally they would put it down as a gift.
Yeah.
I mean there's no real way of protecting it if they are putting it down as a gift, unfortunately. But I guess it's just down to the parent to make sure that they trust their kid and to give them that money in the first place, I guess.
Yeah.
I mean, but there are options if it's, for example, you're gifting one of your children a large sum of money and they're moving in with their partner, you can enter into a declaration of trust to make sure that money stays with their child in the event that,
They
break up or, so there are ways to protect it in that sense.
Yeah.
But generally, if you're gifting money to a child, then that has to be a gift in the eyes of the lender.
It's a good one actually, because we had that recently, and we always advise our clients to get declaration trust because unfortunately you do see it where you'll get some first-time buyer couples and they get a gift and they split up down the line. Unfortunately, that's 50-50.
Yeah, I mean, it's not the most romantic conversation.
No, it's not.
Unfortunately, but these things happen.
Yeah.
So, we do push for it.
Yeah.
And I've got a fair few clients have been thankful at the end of the day. So, but it's all things to think about, isn't it? That's what we're here for. It's risk mitigation, isn't it? Yeah. So, it's important things to consider.
Are there things you can do during the term of the mortgage? Sort of overpaying, does that help?
So most mortgages you can overpay by 10%. They changed the rule years ago because people were tied into mortgages and they couldn't overpay without penalties.
Yeah.
So they changed it and it's 10% across lenders. So some do 20%, but 10% penalty free every year. I mean, most people are never going to pay off 10% of the mortgage a year. I've never seen it, but that would be a huge chunk. But anything over 10%, they'll charge you an overpayment charge, which could be a percentage of the loan. So if it's a 2-year fix, it could be 2% in the first year, 1% in the second year. 5-year fix, it could be 5, 4, 3, 2, 1. Depending on the lender or some individual. But
even little monthly extras can help bring down the overall term of the interest.
And if an extra is off the capital as well.
Yeah.
People don't realise. If you pay £20 extra a month, that's off the capital. So I'd be surprised how much your impact that can make over the term.
And what should you do if you pay the whole thing off?
What should you do?
What should you do?
Everyone's got a view on that, haven't they?
Would you go buy to let or anything like that? Single property?
Yeah. I mean, at the moment it's harder because obviously interest rates gone up. It's reduced the yield for landlords. So we have noticed that's been slower. But it is an option, definitely. Property traditionally always go up in this country with the housing crisis. Why is the housing crisis? Property prices will always ultimately go up, aren't they? You just little crashes. Buy-to-let's not a good option.
Yeah. Do you see many buy-to-let? It's been a big push by the government to try and, it seems, sort of stop people wanting to get into that with high taxation.
Yes, but then at the same time, there are reliefs to limited companies. So, they get stamp duty relief if you're buying a probate property and you fit the criteria. You can actually buy a second property through a limited company and pay zero stamp duty, which is, a huge reduction on your outgoings and your costs. So, there are incentives there, and we're still seeing, buy-to-lets coming in and people interested. Like you say, the yields are just ever decreasing, aren't they? So in terms of holding them and letting them out, that's probably sort of slowing down. But in terms of buying and flipping and keeping them moving, we are seeing the property developers still going at a reasonable pace. Yeah.
I think the key is to find the one with the good yields. That's
Yeah.
the key.
Yeah.
To find those properties.
Yeah.
But yeah, depending on what people do. It depends on what kind of money they've got, which is best. Or best keep it in the bank or buy a property. Depends on the individual circumstance.
Yeah. So, anyone considering buying their first property, is there any sort of tips you'd give them?
I think, I mean, yeah, firstly, in terms of costs and outgoings, it's always good just to get quotes and, not just for legal services, for everything, and just make sure that you know all of the money that you're going to be spending.
So removals.
Yeah, everything. It's good to get a full idea because obviously, it's like anything. When it's your first time doing something, you want to be as well informed as possible. And there's always going to be, little things that pop up along the way. But it's good to be as informed as possible in terms of how much you're going to be spending because, you could have a deposit and you think you're ready to go, and actually, once you realise all of the extra costs that could go along the way, then the deposit.
And that's just for purchasing it.
Yeah, just for purchasing.
And then you would take them through like the outgoings, would you? So council tax and that to make for the affordability.
Yeah, so most first time buyers they'll get in contact to say, I have no idea what I can borrow. Can you tell me? So that's always the first thing we check is we'll get a fact find, see what they can borrow, give them a rough idea, tell them about additional fees that we're speaking about there, and the mortgage products available, and then kind of go from there really. And if it works for them, then great.
Yeah,
and they can start looking for properties. Doesn't give them something to sort of aim for and come back. So
excellent. Okay, thank you very much.
Thank you.
Thank you.
pleasure.
Excellent.